Hello guys. When people say, I bought Nio, what they usually mean is, I bought shares of Nio Inc. And that distinction matters. In this video I want to do a deep but simple walkthrough of the real risks behind owning Nio stock. Not fear-mongering, just a clear-eyed look. Yes, demand and orders look strong, and many commentators say bankruptcy is practically impossible because of the order backlog and potential buyers. But that doesn't mean there aren't meaningful company structure risks you should understand before you press buy. So let's break it down step by step. This is not financial advice. Please do your own research. First, the basic headline, Nio Inc., is not the same legal entity as NIO China. When you own shares of the US-listed ticker, you own Nio Inc., a listed holding company that controls a large stake, roughly 90% of the Chinese operating company NIO China. That split is normal for many international listings, but it creates an information gap. Financial statements for the listed shell and the operating business can look very different, and some critical numbers lie beneath that surface. Here's the part that trips a lot of people up. We can read Nio Inc.'s balance sheet and see how much cash that listed entity reports. But NIO China's cash position, the cash that actually funds day-to-day operations, factory builds, R&D, and things like battery swap network expansion, is often not visible to investors in the same detail. So while Nio Inc. might show tens of billions of RMB in cash on its books, we don't automatically know how much cash sits inside the operating Chinese business unless they disclose it outright. A concrete example of how this matters, say Nio Inc. reports 27 billion RMB in cash, then announces it will move 20 billion RMB into NIO China. That leaves the listed shell with only about 7 billion RMB. On paper, the group still has the same aggregate cash, but the liquidity that Nio Inc. shareholders can directly see and rely on has been materially reduced, and the money has been moved into the operating company, where we have less transparent reporting. That raises the obvious questions. Why is the cash being moved? How much cash does NIO China actually have already? And is NIO China using the money to plug holes or to invest for growth? Next, consider the government stake in the operating company. Local governments and early strategic investors sometimes hold minority positions in Chinese operating companies. When the listed parent decides to increase its stake in the operating business, money changes hands, often to buy out those local shareholders. That means cash from whoever supplies it, potentially Nio Inc., or external financing is used to repurchase those local stakes. The result? Nio Inc. increases its ownership of the operating company. Local holders get cash out, and listed shareholders may be diluted if additional shares are issued to raise the money. The central issue is that dilution, if it happens, impacts Nio Inc. shareholders disproportionately, while the local or onshore shareholders can get their liquidity without suffering the same dilution. That asymmetry is uncomfortable for minority investors in the listed entity. This structure also feeds a worry many investors have voiced. Could Nio Inc. become a financing vehicle and a TM funneling capital into the operating company? I can't prove that will happen, but the structure makes it possible. If NIO China needs capital and the parent keeps supplying it through equity issuance or intra-group transfers, the holders of Nio Inc. shares could see their stake diluted repeatedly, while the real operational improvements remain on the books of NIO China, which we can't fully audit from our seat in the market. That's the transparency risk. Let's talk about the business lines you actually care about: charging services, battery swap, and vehicle sales. Management has said the charging business, public chargers, destination chargers, etc., is profitable. That's encouraging, but most of those profits flow through the operating company's financials. Battery swap is a unique asset for Nio. It's a competitive strength, but also capital intensive. Many users have free or subsidized swaps as part of ownership packages. Whether the swap business can be profitable at scale depends on swap utilization rates, pricing, capital recovery, and network economics. Management has suggested a threshold of swaps per day per station to reach profitability. But again, we don't get detailed line-by-line numbers for that business unless NIO China reports them. So there's a black box. The headline, "Charging profitable," is good, but how profitable and how sustainable? We don't have full visibility. Now, about bankruptcy, people often conflate operational success with legal insolvency risk. A strong backlog of orders and lots of demand do reduce the chance of outright bankruptcy. Buyers and investors generally step in before a company fully collapses. It's reasonable to say bankruptcy for a company with solid demand and strategic interest is unlikely. But unlikely is not impossible. And importantly, the risk profile changes depending on which entity you're talking about. The operating company might be healthy or have access to local support. The listed parent could be affected by dilution, accounting transfers, or capital moves that change shareholders' economics. That's why blanket assurances like "bankruptcy is impossible" feel reassuring but don't remove the structural and transparency concerns. So what should a prudent investor do? First, acknowledge the two-entity structure and treat them separately. Read NIO Inc.'s filings, but also track any information you can about NIO China regulatory filings, press releases, and local disclosures. Second, understand dilution risk. When the parent raises capital or transfers cash to the operating unit, that often changes your ownership percentage and the parent's cash cushion. Third, watch the cash flow and capital allocation decisions closely. Why is cash being moved? What is it funding, and who benefits? Finally, demand clarity on the profitability of ancillary businesses like battery swap and charging, because these are the services that will determine long-term margins and capital needs. I'll be honest, this topic makes me wish for more transparency. If NIO China were to list domestically or publish fuller segment disclosures, a lot of the ambiguity would vanish. Until then, we're left with a partly visible balance sheet and some reasonable concerns about who gets diluted and who benefits from internal capital flows. To sum it up, owning NIO stock means owning a listed holding company, not the full operating picture. The separation between NIO Inc. and NIO China creates information gaps about cash, profitability, and capital allocation. While strong demand and order backlogs make bankruptcy unlikely, the real risk for listed shareholders comes from structural moves, cash transfers, stake buybacks of local shareholders, and dilution that can change your economic exposure. Battery swap and charging profitability are promising but still opaque. Do your own due diligence, read the filings, track announcements about onshore disclosures, and always factor the two-entity structure into any investment decision. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.